Hey, this is Chris from Stockspot, Australia's largest online investment advisor, and in this video I'm going to be sharing our performance update for the 12 months to the end of September 2024. Now, it's been a very strong year across all of the assets we're invested in at Stockspot, with the portfolios ranging in returns from 16.2% for our conservative amethyst strategy, all the way through to 21.9% over 12 months after fees for the topaz high growth strategy. That historically has been our strongest 12 months on record and was really driven by strength across the board in the underlying assets within the portfolios. So starting at the strongest performer, gold put on 32% over the last year. This is an asset class I've been talking about for a long time. I think it's an incredibly important one for diversified portfolios, and one that more asset allocators out there are shifting assets from fixed interest, government bonds, into gold for all sorts of different reasons that I've explained. And in the blog, in the comments below, you can read more about our thesis for why gold should be in your portfolio. A 32% return across our portfolios, given that they all have a 15% or so weight to gold, meant that gold added about 5% of returns to all of our portfolios over the last 12 months. The next best asset class in our portfolios over the last year was the Global 100 ETF, which returned around 26%. Really, this was driven by strong returns from US technology companies, which are very large weight within this portfolio. In fact, US shares make up over 70%, and technology is now the largest sector of the US market. So businesses like Microsoft and Amazon and Nvidia really added strength to this part of our portfolio. Plus, because it's an unhedged ETF, the weakness in the Australian dollar also contributed to the return. The next best asset in our portfolios was Australian shares. It returned 21.7% over the last year. Really, it was a story of financial stocks over the last 12 months as banks put on fantastic returns in the 30 and 40% range, whereas resources really lagged behind over the last 12 months due to a softness in commodity prices. After Australian shares, emerging market shares also did pretty well at around 17% return. The market that was really leading within emerging markets was the Indian share market, which has been going from strength to strength as their economy does very well. The Chinese market was lagging and really dragging that index lower up until the last few weeks, where the stimulus package from the Chinese government really set that market alight and helped Chinese shares recover what was otherwise a pretty poor year of performance. And then finally, government bonds in Australia didn't do too badly either over the last year, a return of 7.2%. Really one of the better years that it's had over the last few years, particularly as interest rates had been rising. What we've seen over the last 12 months is people have really tempered their expectations of further interest rate rises and are now actually expecting interest rate cuts in Australia in 2025, and that's what helped government bonds over the last year. So with markets so strong over the last year and our portfolios returning 16 to 21%, a question we are getting is, should I be sitting on the sidelines waiting for a market fall? Our view with clients is always that it's hard to pick when that fall might happen, and it's very easy to anchor to a point where the market never falls below. So our advice is actually, if you are worried about the market falling, but you want to be invested, dollar cost average or continue to drip feed money into the market over a period of 6 or 12 months. That will give you the opportunity to buy lower if the market does have a dip, but it won't allow you to feel that regret of missing out if the market continues to go up, and allows you to enjoy those long-term market returns that we've been seeing for 10 years now at Stockspot.